I'm going to talk a bit today about retail property and retail property prospects for 2022, where I see things in that sector. I think I must start with a bit of background that guides my longer term thinking in the retail property sector. And that relates to the deterioration in affordability of retail property since the mid-1990s. If you use MSCI data, which goes back to 1995, you plot it on a graph, adjust for GDP, for inflation in the economy, you see a serious rise in, or deterioration in affordability, or rise in values, in rentals, in operating costs. Everything about retail property compared to the mid-1990s became expensive in the 2000s, the 2000 to 2008 period roughly, or the late 1990s as well. Real retail property capital values, when adjusted for general inflation, virtually doubled during that time. Net operating income virtually doubled, rentals virtually doubled, operating costs virtually doubled. So it became a lot less affordable in every single way over that period. Now the question is, was that justified, that deterioration in affordability of retail property? And yes, it was, I believe. Back before the global financial crisis in 2008-9, before that, we had a consumer boom of note. We had cuts in interest rates in the late 1990s. We had the end of boycotts and sanctions earlier in the 90s, which boosted the economy, unleashed, as we normalized trade with the rest of the world. Then down came interest rates radically since 1998. At that stage, there was a far less indebted consumer, so they could go on this big consumer spending spree and housing spending spree. And so this big consumer boom drove retail property to a large extent, and an economy growing at 5% plus, employment growth, strong real disposable income growth, all those factors underpinning retail property and consumer demand. So it was justified, and retail property was the darling of the commercial property sector in those times. But since the global financial crisis, we've never been the same again. The economy had a muted recovery briefly after the financial crisis and started to stagnate. Structural problems in this economy getting ever worse, and high levels of debt now constraining it as well. High consumer debt, high levels of government debt, even high levels of corporate debt. So it's a very different environment now, and the fundamentals of the economy are a lot weaker, and the fundamentals of the consumer are a lot weaker than what they were prior to the global financial crisis. So that, I believe, has necessitated a correction in retail property rentals and values across the, on average, to get more in line with what are now very weak economic fundamentals. We have been in correction mode since a year or two before the lockdown period, and then more in terms of real value corrections. So nominal value corrections were so low, or increases were so low, they weren't keeping up with general inflation, and so you had a real value correction. That went to all-out nominal value decline in 2020, and probably last year as a whole as well. And I believe that more correction is due. But I'll tell you why in a few seconds. Let's talk about the retail property fundamentals. Now, firstly, the tenant population has recovered somewhat with its payment performance since hard lockdown of 2020. If you look at TPN data, at one stage, about May 2020, only 42% of tenants were in good standing with their landlords with regard to rental payments. That increased at a stage last year, towards mid last year, to about 66%. And then sort of tapered to 64% later last year. So now before lockdown, that percentage was above 70%. So the tenant population still not fully recovered to pre-lockdown levels, and really battling to make that last progress as they and improve their finances. The consumer too is better since 2020 hard lockdowns, but not wonderful. Job creation is really not coming to the party in a big way, although the economy has grown during last year and will probably grow further this year. but we're not seeing renewed job creation in the numbers just yet. So that constrains the growth in real disposable income. And of course, interest rates have started to rise now. Consumer sector is highly indebted, so that takes a bit of a toll. And of course, effective tax rates on personal taxes are rising. In other words, bracket creep adjustments aren't enough to fully compensate for inflation bracket creep on the tax brackets. And so for a good number of years now, every year that tax burden as a percentage of disposable income gets more. Then at local government level, municipalities have been increasing rates and tariffs at above inflation levels. And of course, Eskom, we know about electricity tariffs too. So there have been various sources of mounting pressure on the consumer. So they're not in a wonderful state. But yes, after the recession of 2020, their situation has improved moderately somewhat. So everything's improved but constrained. I guess that's the message. And so retail sales have most categories have stabilized or in the process of stabilizing. The more luxurious entertainment, eating out and that type of thing has lagged and probably will still lag this year, although playing catch up. Again, better but not wonderful. So how does that then, if we take it through to retail centers, well, I think that you get some overall growth in retail sales during the course of this year. The luxury non-essentials that often are more influential on bigger regional center performances, probably playing some catch up. I refer to entertainment and the wining and the dining, and where shopping malls are a destination type of, a non-essential type of destination. They can play a bit of catch up. So in recent years, regionals, super regionals have underperformed the smaller convenience and community shopping centers that are more focused on essentials such as grocery and food shopping and other high frequency purchases. They can close the gap on that, but I still would expect the smaller centers, the convenience centers, to outperform them. We can then also see that lower income end centers still outperform, but the luxury type dependent centers close the gap on them too. Those are centers that are often dependent on what's quite a stable source of income from things such as social grants. And those centers are more essentials focused, and that retail spend is normally more stable. So lower end type of more essentials focused retail centers better, and often you might find them out in rural areas, very poor areas that are highly dependent on social grant income. Now, social grant income doesn't shoot the lights out, doesn't even keep up with inflation at the moment in terms of its increases. But in times of recession, in the past year or two, much more stable than other sources of income. And so we did see certain landlords pointing towards rural, lower-end shopping centers as being their outperformers during that time. They can still possibly outperform, but I think the gap will be narrowed between their outperformance and the regionals and super regionals who might have better fortunes during the course of this year. The big interesting thing to watch in the near term for those low-end type of retailers is the debate about basic income grants. There's been a push to put in place basic income grants. I don't think it's sustainable in the longer run from a government finances point of view. Government finance in this country is already in a bad state. The debt to GDP ratio is rising. The increased risk of government default has been coming our way, and rating agencies downgrading us partly as a result of that. So I don't think it's sustainable. But there are political imperatives, and there are people that are influential people pushing for it. So it's a possibility. But that's the interesting one for those lower end essentials focused shopping centers. What happens to cap rates then? I believe that capitalization rates continue their gradual drift higher, broad gradual drift higher. Government finance expected to carry on weakening, and the debt to GDP ratio rising as government bond issues are significant. That puts upward pressure on government long bond yields, which influence the longer term debt market. those will be influenced too by short-term interest rates rising, should they carry on rising, and we believe that they will carry on rising gradually during this year and during next year. And then, of course, global interest rates. US Federal Reserve strongly signaling rate hikes to come, and that has an influence on global longer bond markets, which filters through in influence to the local bond market too. Everything hangs together in those markets. So I think that government long bond yields can be experiencing upward pressure during the course of this year, and that filters through to capitalization rates. There is that partial link as well. So where does that put capital values for retail property? Well, I think after 2 years of all-out value decline, we can get back to some low nominal value growth. Low nominal value growth, 1%, 2%, that type of number, not keeping up with general inflation. So in real terms, we still have real value correction, and that can carry on in the coming years, that real value correction. That's how I see it playing out, from all-out nominal value decline coming to an end after the lockdown period, coming to an end this year, go back to positive nominal growth, but still real negative growth. Still a constrained environment, still all the pressures, the cap rate pressures, the consumer pressures, the tenant performance pressures, and so on. Still a constrained but better environment. Where does that stack up in terms of relative performances of property classes? I think retail is the one in the middle. Office will probably still be the underperformer. I think that the whole work from home issue and the hoteling of desk space and more efficient use of desk space, because there's a lot of empty desk space around, and many office tenants cutting their space requirements. I think that's the future for office in the coming years. So that's the underperformer. Retail somewhere in the middle, not as hard hit in the short term by online retail, although online retail is increasing in significance all the time. On the top end, industrial property, its fortunes boosted by optimism in that increase in online retail, and a lot of online retailers gearing up for greater sales in that regard, and greater need for warehousing and logistics space and so on. So industrial seems to be in the relative pound seats at the moment. That's how I see the relative performances of the sectors. Finally, let's see what evidence we've got of better performance this year, and look at our broker surveys, which are the most up-to-date thing we had. And late last year, our fourth quarter broker survey started to show that when we asked the brokers, do you believe that vacancy rates in retail have risen, fallen, or stayed the same over the past 6 months prior to the survey? A slight majority were pointing towards vacancy rates declining. I don't think that's significant yet, but I would say what they are at least saying is that vacancy rates have possibly stabilized overall for the sector in their experience. And should that be the case, well, that's quite significant, because that's a significant change, because in recent years, for quite some years, vacancy rates in retail have actually been rising, and very strong jump in perceived by the brokers during 2020. So that points towards some stabilization, at least in vacancy rates, not yet convincing signs of decline, and that helps. They've also pointed to market activity in the rental market having increased steadily since the end of hard lockdowns, and in the buying-selling market as well. So it seems to be a significantly better space for retail to be in. If I compare the broker survey performance perceptions to office and industrial, they also perceive it to be somewhere in the middle, industrial on the top and office on the bottom.